Good evening, ladies and gentlemen, and all esteemed analysts who have come to attend our first meeting post-listing of our issue. Friends, you might be aware that we started our wealth business back in 2002, and we have built it up in last 20 years to a good level and evolved a very unique, philosophy in managing wealth. I remember, still recall my old days when I used to meet a lot of analysts in my Birla Group days as president of Indian Rayon. And it's always a pleasure to be amongst analysts, though we are not able to meet physically, which I would love that sometime we do that. But still, it's a great, advantage. I have always learned a lot of things in talking to analysts and a lot of insights which you get while talking to you. So, friends, today we are going to talk to you about our performance for the third quarter of the current year and the 9 months of the current year. For making the presentations on the business and our performance, I would request Anand Rathi to please do that, and then after that, the Q&A will follow. Thank you, and it's a pleasure to welcome you once again. Over to you, Amit.
Thank you. Hello, everyone, and thank you for joining us on our first earnings release call. It's actually interesting to be on the other side of the table for a change, presenting quarterly results. Different feeling. But coming to the numbers, I think we've had a strong performance, overall performance across all metrics in the business. As you guys would have seen, our consolidated revenues for the third quarter was almost 108.6 crores, which was up 55% YOY. And for the 9-month period was 310.8 crores, which was also 54% year-on-year growth. So we had a strong sort of revenue growth. Profits were also up 32 crores for the third quarter, 144% growth there. And for the 9-month period, we had a 92.2 crore PAT, which was up 168%. Overall, I think ratios are all looking good. ROE for the 9-month period was in excess of 40%. This is really backed by, strong AUM growth. Our AUM was up 28% year-on-year to 32,171 crores. Within which I think we saw very strong growth in equity mutual funds. We had almost a 64% YOY growth in equity MF AUM in our overall pie. Client additions were very strong. We added almost 800 families in the first 9 months. Last year we had a record 988 additions in the last financial year. I think we're on track, hopefully, to beat that number this year. And on the flip side, I think also client attrition as a percentage of AUM has been low. It's been just about 1% of AUM for the first 9 months. On the RM side as well, we added about 20 RMs this year, most of whom were from our account manager cadre. And I think as a matter of policy, we believe this will be our single largest source of RMs, future RMs, and will also be a competitive strength. Our regret RM attrition also has been around 1.5%. So things have been steady on the client and RM side, and overall performance has been fairly strong. On the product side, we've been able to successfully diversify our sourcing of MLDs to some unrelated issuers as well now in the last quarter. Our intent is to move that part of the business to about 50% of the overall MLD distribution that we do. We continue to evaluate some degree of diversification in the product basket, but something that meets our overall objective of liquidity and risk-adjusted returns for customers. On our two fintech subsidiaries, I think they're also very interestingly poised, as we can clearly see that technology is starting to play a big role in the wealth and sort of the whole intermediation business. The digital wealth subsidiary, it's a direct offshoot of our private wealth business. Here we take the same proposition to the mass affluent customers using tech. Mass affluent customers being customers typically in the range of 20-30 lakhs to a few crores. The entire offering is end-to-end digital using apps, videos, and algorithms. And this business has also witnessed robust growth. We've seen a 38% AUM growth there to 800 odd crores across 3,500 clients. Average client size here being about 20 lakhs. Our other subsidiary, OFA, is India's largest SaaS platform for IFAs, where our tech and apps have become the entire sort of back office for the IFA and back office and front office for the IFA and their customers. Today we have over 5,000 IFAs with about 1.695 million clients. on the platform. The platform AUA of mutual funds alone is about 85,000 crores, bulk of which is equity mutual funds. So I think overall, to sum up, our performance sort of reinforces, our long-term commitment to our strategy and to the client proposition that we have. We all know that the tailwinds, sort of the macro tailwinds in this business are huge. The kind of wealth creation that's happening within India, number of dollar millionaires sort of doubling every 3-4 years. But I think it's important within that our strategy, we really focused on our strategy and said, look, how do we build a business that is highly differentiated and sustainable and also has the ability to ride this wave for the next 10-20 years, right? And I think we've met a lot of you guys, over the road shows. But just to sort of reiterate, our private wealth vertical, uniquely targets customers in the 5 to 50 crore investable surplus segment. These are customers who we think value advice and are willing to pay for advice. This is not a segment that is as competitive, and a lot of people are going either after the UHNI space, which is typically the 50 to a few hundred crores, or the retail space. This is a space where we find the competitive intensity not being as large. It's a slower to build business, but a far stickier business if one can build it successfully. You will also see that the yields that we enjoy in this business are significantly higher than what typically is reported by competition. The other is that offering itself is completely templated. It's almost like a consumer product, which allows for two things. One is, of course, scalability, that our ability to sort of scale this business, train RMs, build sort of effective go-to-market strategies, and also consistent client outcomes. Whether a client comes to an RM in Chandigarh or in Bangalore or in Calcutta or in Mumbai, how can they have the same experience, irrespective of touch point that they're sort of meeting within Anand Rathi? And the third leg, of course, is we've made major tech investments that not only hedge sort of the business prospects, but give us a competitive edge and also an ability to build sort of market-leading positions in adjacent client segments. So I think we consistently sort of really focused on, these 3-4 things that we're doing. And, we believe that the business generally, not just for us, but I think everyone in the business has the ability to compound at 20-25% per annum for the next decade easily in this business. If you've seen our sort of deck, you'll see a slide there on the AUM bridge, which shows sort of the AUM growth, and breaks down the components. And that really sort of is a summary, in some ways, a summary of how this business, how we look at this business, where you look at 12 to 14% annualized sort of market growth in AUM over cycles, and 10 to 12% new additions of assets from existing and new customers, which means that this business can potentially double 3 to 4 years. Every 3-4 years, the AUMs in this business can double. But the key is, of course, is execution and being long-term greedy and not taking shortcuts, which is what we're really focused on as a business, and that's what we're doing for the last 8-10 years collectively as a team. And I think, for this performance, I'd like to thank all my team members, all the RMs and clients, and a lot of people who've been very supportive, of us through the IPO process. And with that, I think from my side, I'm done. I'm happy, we're sort of happy to take questions as a team. Thank you.
Thank you very much. We will now begin the question and answer session.
Yeah.
Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, to ask a question, please press star and 1. The first question is from the line of Abhay Mehta from Eneco Industries Private Limited. Please go ahead.
Yes. Would like to know how you see the quarter starting from April 2022 of the next year.
Sorry, your line wasn't very clear. Can you repeat the question, please?
Yeah, the company's performance, how you see the for the first quarter of the next financial year, that is April, May, and June 2022.
I think, we've given guidance for the current full year and for the next year. It's difficult to predict what the first quarter of next year will be, but I think if you look at our overall guidance, we are looking at a 20% sort of top line growth, a little over 20% top line growth next year, and about a 25% PAT growth for the next financial year.
Okay.
Thank you. Participants, you may press star and 1 to ask a question now. The next question is from the line of Nilesh Agarwal from IIFL Securities. Please go ahead.
Hello. Yeah, good afternoon, sir, and many congratulations on a strong set of numbers. I just wanted to better understand the revenues. So if you could give us an idea or breakup in terms of how did the revenue shape up between mutual funds and MLDs, and the sales that we achieved in the quarter and 9 months on the MLD side.
Thanks, Nilesh. I think overall our mix sort of has been gradually moving towards the largely 2 products which we do, and as we continue to look at more products going forward. But at this point, of the 2 products that we do, MLDs have now come. Last quarter number was around 57% of revenues. The balance was others. I think this number has steadily sort of come down from a 65-67%. Our target is to sort of increase, our book of mutual funds consistently, and I think markets have been supportive. One of the metrics that we're actually tracking is, our trail income, and I think we've shared that in the deck as well, where our objective is to sort of get to a point where 100% of our fixed cost base is covered by mutual fund trail itself. Last quarter, I think that number stood at 86%, and the objective is to sort of get that to 100%. Overall, I don't think we share sales data, at a product breakdown level, but AUMs are there in the deck.
Understood, sir. And in terms of, sir, the cost to income ratio, we have seen a significant improvement this year. So are these numbers sustainable, or there are some one-off benefits that has led to this improvement?
So there are no one-off benefits. In some ways, last year was a little more one-off. I think this business, if you look at outside, there are a lot of fixed costs where operating leverage kicks in. Right, and market also doesn't go up in a straight line fashion. So if you look at market performance over cycles, you might have 2-3 years where the market has flat or no or negative returns, but in the 4th year, suddenly you'll see a 70% jump, which means your tail incomes and all your incomes sort of tend to go up. So I think a lot of the cost structures have remained constant. There's no one-off. It's simply operating leverage that is kicked in at this scale of business, and I think we think this will sustain going forward.
Perfect. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. Congratulations, sir, on a great set of numbers. Firstly, could you give some thoughts on yields going ahead as to how do you see the yields moving for the company? You mentioned that MLDs will be lower going ahead, and also the second question would be on, you mentioned about new products that you would like to incorporate into your revenue model going ahead. So what are these new products, and how eventually do you see the yields moving?
Feroz, you want to take that question, please?
Sure, Amit sir. So when it comes to the structured product, it's not that we expect a reduction in structured product revenue. It's the growth of mutual fund revenue should be greater than the MLD business revenue. Like, for example, first 9 months, our trade from mutual funds year on year have gone up about 79.2% at a faster pace than the MLD or other securities business. That's point 1. Point 2, we think that the yields which are there, 1.2, 1.3 odd% are very much sustainable across product classes. The third point is what other product classes we are evaluating. On a serious note, we are evaluating PMSs as a new an offering, and we are, like Amit said, that we are very, very particular about the risk reward and also the efficiency. That's one of the products which is being evaluated, and so are the AIFs being evaluated for an inclusion at a point in time when they pass the filters of product approval.
All right. That's helpful. So in terms of you talking about mutual funds seeing a faster growth, my understanding would be the mutual fund yield will be lower than the MLD yield. So does that mean that your overall yield going ahead will reduce? And secondly, the PMSs and AIFs will have a higher yield, so would that be an offsetting impact to your overall yield?
So I think, if I can take that, and Feroz, you can add, Rakesh, you can add to that. I think overall this business, I think that in the client segment that we operate in, I think that 1.2 to 1.3, 1.4%, that's the yield that we think, steady state we should be able to manage. Now, product basket will keep evolving based on market conditions, but I think within that, I think we should be comfortable. I don't see such a significant shift where the yields get, dramatically impacted either way. Because even if you look at mutual funds today, our yields are reasonably high. We are, at 90 bips and higher on net mutual funds, and there's some degree of inefficiency there because a lot of customers who come to us with change of broker codes where we don't earn commissions, a lot of assets that are also sitting with zero sort of yields. As we sort of optimize that and sort of get customers into more of a recommended schemes, that efficiency in mutual fund itself also there's a fair bit sitting there which we can optimize. So I don't think, overall directionally the product basket sort of changing over a period of time will impact yields materially.
Okay. Another point on the mutual fund business was the fact that incrementally we're seeing HNIs wanting to take the direct route for investments in mutual funds. Do you see that happening, and how do you compete in this kind of environment?
So let me break it two parts, and I think Feroz can take the latter part. The first part is really, what we're selling to customers is an overall solution. The products within that are not as important from a customer's perspective, whether we're doing, whether it's mutual funds or if it's PMS tomorrow or structured products or whatever product that we're doing. End of the day, the focus of the customer and our solution is, can we get customers to, let's say, 12%, 13% long-term compounded return? Now, within that, if customers are confident that you can actually do that, if you look at the customer additions over the last 2-3 years, we've had record additions, from our own historical perspective, we've had record additions. Customers are willing to pay us. I think the challenge is more probably at the ultra HNI space where the customer is buying a product rather than advice. A lot of the advice is very incidental to the product that they're buying, or in the retail space where there was actually no advice or anything available at all, and where a lot of the digital offerings are sort of impacting that. The space that at least we are in, we are not seeing that as a challenge, and a lot of our customers, these are customers of fairly financially literate. A lot of them are CXOs, CFOs, CEOs of large companies, successful entrepreneurs in major cities. So we're not seeing that as a challenge, and Feroz, you may want to add to that.
Yes, Amita. So since the direct route has been available from 2013, and we've built this business reasonably over the last few years on the mutual fund, on the regular route, like Amit said, as long as the portfolio objectives are being met, the client is very satisfied. Point two is that especially after October 2020, when other competitors had to surrender their advisory licenses largely, it has actually reduced the competitive intensity on the direct mode.
Okay, I think that's helpful. Just last question. On the Anand Rathi OFA platform, you talk about 85,000 crore of platform assets. How do you make revenues on these assets, and what is the size of this business?
So right now, what we do is only charge a software subscription fee for the platform.
Okay.
So what we're doing is essentially, building a digital network of IFAs and their customers and IFAs. There's several other monetization opportunities that one can think of. But that's, from our strategy perspective, we are holding on to that for a year or two before we scale this even further. But there could be several monetization opportunities sitting there.
So what was the size of this business in, say, 9 months? in terms of revenues and PAT?
So revenue is small. So each IFA we would charge an average of, let's say, 1,000 rupees a month, to give you a sense.
Okay.
So it's a pure software SaaS business. So it's another way, today trying to build out a broker, sub-broker model like a Prudent or an NJ, 30 years back it made sense. And we approached this business very differently. And we said today the biggest challenge IFAs are facing, and these are IFAs who've chosen to remain independent, who are not part of an aggregation network. The biggest challenge they are facing is tech. The competition that they're facing is from tech startups going after their customers with, sort of these digital offerings, and which is what we sort of solved for. Now the network can be built on, sort of upsell advisory solutions, brokerage, sub-brokerage solutions, loan products. There's a lot of other stuff that one can do here with this base. But at this point of time, the focus is not really, this business is, a marginal revenue contributor at this point, but the objective is this revenue is not the core part of the strategy. Right now, it's really sort of building scale within this business.
Okay. Got that. Thank you so much. Please stay safe, everyone.
Thank you.
Thank you. The next question is from the line of Umang Shah from Kotak Mutual Fund. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations on a good quarter. I have two questions. One is already answered. I just have one. If I look at the AUM split in the presentation deck, it mentions about equity and debt MF, and then there is other securities and others. So what would be others? I'm assuming other securities is MLDs, and what would be others?
Others would be stuff lying in the demat account, which is waiting to be, from our perspective, waiting to be transitioned into our, sort of managed portfolios. So it could be, when customers come in, Umang, they come in with, stocks, bonds that they might hold elsewhere, or what are securities that they hold. So when they come in, they will do a transfer of assets in, and there will be a small percentage of such assets which are sitting there, which are not part of, our traditional sort of advisory process.
Understood. So these are like the custodial assets of the clients.
Yes.
Okay. All right. Sure. And the second question was related to PMS. Just wanted to understand from a medium to long term perspective, do we see manufacturing as an opportunity, or our focus will only remain on distribution?
So on manufacturing, I think if we can do, traditional long-only manufacturing is something that we don't believe at this point, is the right way for us to go. There's enough manufacturers available in the outside sort of community, and that's a business that requires a different level of scale. Wherever we can provide an edge is something that we could look at manufacturing, because any manufactured product also your yield would be 2.5%, including a manufacturing income. So anything which is differentiated, something that we continue to evaluate and work on an ongoing basis, but we will not do the traditional long-only stuff.
Understood. That's helpful. Thank you so much, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Franklin Moraes from Equitas Wealth Advisory. Please go ahead.
Thanks for taking my question. So if I look at the revenue trends, FY18 to FY20, we saw a good increase in revenues, but FY21 there was a dip in revenues, and that's coinciding with also the reduction in RMs. So is that specifically got to do with COVID, or has that been largely because of the RM reduction?
So two uncorrelated stuff, but Feroz, Rakesh, you guys can take these.
Rakesh sir, you want to take this?
No, I think the number of RMs coming down, was on account of it was all triggered by COVID. When we sort of looked at our people, and if there, every company, I suppose our company as well, looked at inefficiencies and therefore took action accordingly, both in terms of manpower cost as well as other costs. Yeah. So some of the reduction is on account of that, and the revenues down is on account of the trail incomes being down on account of the huge market fall that happened. Does that answer?
Yeah, that's very helpful. So secondly is, if I look at the RMs, we have increased 20 RMs, over the last 9 months, and there has also been a conversion from AMs to RMs. So wanted to understand what is the criteria for, a conversion of an AM to RM, and what would be the average tenure of these AMs which have been converted?
Well, the AMs normally spend about 3 to 4 years with us, and then we promote them depending on their aptitude, and then they are mentored by the corresponding RMs to take them to see them through becoming profitable RMs.
Yeah, but is there some rough base business or anything of that sort, they need to generate, or they would have kind of generated for them to get qualified? Normally what happens is that the RMs who are mentoring them transfer 10 to 12 crores or 15 crores of assets and clients to them as a starting capital, so to say. And then in the process, they cold call and get new clients. And our sense is that within about 1.5 years or so, they should get to about 40 crores of AUM.
So if I just add there, I think, our strategy there is most of our AM pool today, we are hiring very, aggressively mix of management graduates from top business schools, including IIM, chartered accountants who come in. And these are basically, while they're doing their role as account manager, they're in some ways apprentices, learning the business the way the Anand Rathi way of doing business, learning how sort of successful RMs have built their books and how they've sort of done that. And towards that journey, as the aptitude is sort of proven, these are inherently very sharp guys. They start off with a small base, but are able to quickly sort of grow and become viable independently. Second, from our perspective, it's a lower cost and a more sort of sustainable way of creating RMs, right? Because the challenge in the business is how do you get enough trained RMs who understand your way of doing business, are sort of integrated into the culture, and stick with you over long periods of time. So even today, amongst our top 10 RMs, 60-70%, most RMs are actually ingrown, in-house RMs who sort of started their journey within Anand Rathi.
Yeah. And last question from my end is we are getting into, newer segments like AIF, PMS and so on, which are kind of, slightly more volatile in terms of revenue recognition. So while we are quite hopeful and, positive about like 10 years CAGR being around 20 to 25%, is there a way to kind of iron out the volatility in revenues?
I think the volatility, I don't think some of these, we will not do products like trade. So we're not looking at, for example, would we do a technology pre-IPO fund? I don't see ourselves doing something like that. Would we do a startup fund or a distressed fund? I don't think we see ourselves doing, which is more a flavor of the season kind of AIF, or alternative opportunity. For us, something that's, one of the filters that we've used so far is the underlying investment to be liquid. So that the client's ability to get in and out has to be unrestricted. The second element has been that, look, there needs to be enough sort of risk-adjusted performance data backing this up, historical, right? Can we look at last 10 years, 20 years, 30 years of data and think this is how this will perform, and can it become a long-term feature within the allocation rather than a tactical 2-year, 3-year thing? So even when we will look at some of these things, they will come in from a really long-term perspective rather than opportunistic distribution opportunities. They will be more something that fits in to the portfolio from a risk-adjusted perspective over a 5-10 year perspective. That's the only kind of product that will kind of come in, if at all. So I don't think that will create any sort of volatility around revenues. I think our ability to sort of have visibility over cycles, that's something that we are keen remains an integral part of the business.
Yeah, thanks a lot.
Thank you. The next question is from the line of Parth, an individual investor. Please go ahead.
Hi, sir. Many congratulations on the great set of numbers.
Thank you.
The net inflows from existing clients seems a bit on the softer side at 18 lakh average per client in the first 9 months of FY22. Given the fact that our client attrition is not much. So why are the gross flows a bit on a weaker side from the existing clients?
I think as a percentage of AUM, if you look at about 4-5% odd. So in a year, if we get, between 5 and 10% of fresh assets from existing clients, that's been historically the good number, because what happens is, while a lot of clients put in, clients also have requirements as well. So attrition is of customers who've moved out of the system. But you also have customers who have life events, somebody's got a wedding in the family, somebody's got something where people also, so that net number usually is a 5 to 10% number, is a fairly healthy number from existing clients.
Okay. And what would be the fresh MLD distribution in the 9 months of FY22?
So that's number that we don't, discuss much. But on an overall AUM number, that's out there.
Okay. And sir, you had invested around 100 crores in one of the group companies back in FY20 as per the DRHP. So what was the intention behind investing in this company, and are we planning to make it a wholly owned subsidiary?
No, that was an investment in the group NBFC. And at that point of time when the investment was made, the wealth entity was a privately held entity and had fair amount of cash. And the NBFC was something we were looking to capitalize. And at that point, the decision was made to invest from here rather than dividend up and pay 40% tax and invest the net amount. So there's no further investment that's going to happen. And whenever there's a liquidity event, in the NBFC, we will look at opportunities to sort of even, reduce the exposure here. But there's going to be no fresh investment from this entity.
Just to add, Amit, this entity where it is invested, they did the right issue just recently, but the wealth has not participated in the right issue and kept the investment at the same level and not increased it.
Okay. That would be from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Ashutosh Pandey from JM Financial. Please go ahead. Mr. Ashutosh.
Yes, Mr. Pandey. Yeah.
Please go ahead with the question. Your line is unmuted.
Hello. Many congratulations for the numbers. I just wanted to understand what's the ratio of our trail and transactional AUM. So
our mutual fund income is pretty much trail. That number is
40%.
I think it's about 41% for the last quarter. Is the mutual fund trail. Our transactional income is slightly different when you compare it to what is traditionally classified as transactional income, because the transactional income for us also comes from products like MLDs, which are recurring in nature. So it's not a new transaction that we need to. So if a client has a product A which matures, 3 years later, the client is going to get into a fresh product of a similar nature at that point when it matures. So it's not like you have to find a new product, or you have to do equity trading, or you have to, do something which is opportunistic and generate the transactional income. So even the rest of the income is actually in some ways has fair degree of visibility on maturity. So when it matures, the customer actually rolls over into a fresh product.
Mr. Pandey, does that answers your question?
Yeah, thank you for the information.
Thank you.
Thank you.
The next question is from the line of Rohan Mandora from Equirus. Please go ahead.
Good afternoon, sir. Thanks for the opportunity and congratulations on good set of numbers. So would it be possible to share the AUM bridge for the mutual fund assets?
For the mutual fund?
Assets, mutual fund AUM that we are having, the AUM bridge, like we have shown on slide number 11.
No, I think then that breaks down into product levels of sales. We are not doing product level sales. It's just an overall AUM level bridge that we are showing.
Because if you were to look at the data, there's been a movement in the mutual fund mix between, say, the equity and debt. The shift is getting more towards equity-oriented mutual funds. So if you can just talk about how is that trend moving, and are we going to have more share of equity-oriented mutual funds incrementally?
Feroz?
Yes. So out of the 18,899 crores of equity mutual funds, the proportions of equity net sales would be greater given the lower debt yield. Yes, you're right in assuming that there will be a larger net mobilization on the equity mutual fund side.
Sure, sir.
And you can see from the statement that it has moved, equity mutual fund percentage has moved from 36% to 44%.
Right.
Yeah.
Sure, sir. Thanks a lot.
Thanks.
Thank you. Before we move to the next question, a reminder to the participants, to ask a question, please press star and 1. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah. So just a follow-up on this MLD question this participant had asked. Could you re-explain the revenue model for a MLD?
The revenue model for the
market indemnity.
Yeah. Feroz, you want to take that?
Yeah. So the MLDs which are sourced from the issuer, now an external issuer as well, are bought and then sold at with the income. So it will be categorized as trade in security. That's why it's mentioned as other securities. So you buy a security, and then with an approximate 1.2-1.3% per annum, the security is sold to our distributor to the clients. Does that answer?
To the client. Okay. And when it gets matured, what happens at that point of time?
Yeah, the issuer buys them back.
The issuer buys them back. Okay. And what would be the cash on the balance sheet as of end of December?
Rajesh?
Jugalia Rajesh. Yeah.
So it was 86 crore. No, that was the cash flow which we have generated.
On the balance sheet, how much is the cash?
The cash and cash equivalents were 60 crore rupees, plus we had the fixed deposits of 70 crore rupees. So it was total 130 crore rupees was cash and cash equivalent.
Okay. All right. Thank you so much.
Thank you.
Thank you. Participants, to ask a question, please press star and 1. As there are no further questions, I would now like to hand over the call to the management for their closing comments.
Thank you, and I request Rakesh to please thank and do the closing remarks.
Well, I'm absolutely delighted to be here in the first investor conference post-listing. And I'm also delighted that the numbers that we presented were to the liking of many. I would like to thank each and every one of you who sort of participated in this conference, and hope that we've been able to satisfactorily answer some of the queries that you might have had, and would build confidence in within yourselves as well as your investors. I think Amit very rightly said that there's very, very high potential for this business, and that we as management would endeavor to sort of capture that potential and have a decent growth in our business in the years to come.
Also, I think that we would be having a higher proportion of trail business as we go along and less of transactional business. Though our transactional business, significant part of that transactional business is repurchase and therefore not as risky as other transactional businesses. Once again, thank you very much for joining us on this conference, and look forward to your participation in the future as well. Thank you.
Thank you for being part of the conference call.
Yeah, thanks everybody once again from all of us for joining and participating. Yeah.
Thank you.
So, Tuja, carry on. You have to. Yeah.
Thank you all for being a part of the conference call. If you need any further information or clarification, please email on vishalsangvi@rathi.com or at rajeshputra@rathi.com. Ladies and gentlemen, this concludes your conference